Paul Burks was an online marketer working out of Lexington, North Carolina. In January of 2011, he launched a website called ZeekRewards, built on top of a penny auction site he already ran called Zeekler. Members could buy bids for the auctions, but Zeek also let them earn daily rewards points just by helping to advertise the company online. Those points could be redeemed for cash. Burks called it the retail profit pool. He told members they were collectively receiving 50% of Zeek's daily net profits, split among everyone participating. Every day, a new percentage return would post to their accounts, sometimes close to the maximum allowed, 125% of what they'd put in. Here's the problem. Those daily profit numbers weren't calculated from anything. Burks didn't keep the books and records you'd need to actually measure daily company profits. He simply made the numbers up himself, day after day, and posted them as if they were real. To keep new money flowing in, Burks and his team ran weekly conference calls and leadership calls, where members could dial in and hear him describe how well the business was doing. He also held in-person red carpet events, where investors traveled to hear the same claims made directly to their faces. Websites, emails, and online promotions carried the message further. Zeekler's auctions were framed as a booming, wildly profitable business, and the rewards program was framed as everyone's share of that success. None of it was true. When the Securities and Exchange Commission later investigated, they found that roughly 98% of all the money coming into Zeek wasn't profit from any auction business at all. It was cash from new investors, being used to pay the people who joined earlier. That's not a rewards program. That's the exact mechanical definition of a Ponzi scheme. The math only works as long as new money keeps arriving faster than old money needs to go out. By the summer of 2012, it didn't. The promised 125% returns had built up a mountain of liability the company could never actually pay, and it kept growing every single day the scheme stayed open. On August 17, 2012, the SEC filed an emergency action in federal court in North Carolina. Their complaint alleged that Zeek and Burks had raised $600 million from more than 1 million investors around the world, and that the scheme was teetering on collapse. In just the final month before the shutdown, Zeek had brought in about $162 million while paying out about $160 million. The gap was already vanishing. The court froze Zeek's assets immediately. According to the SEC, the company had paid out nearly $375 million to investors by that point, and still held about $225 million more across 15 different financial institutions, domestic and foreign. Burks agreed to a settlement, without admitting or denying the allegations, handing over his interest in the company, paying a $4 million penalty, and cooperating with a court-appointed receiver. The SEC also noted Burks had personally taken several $million for himself, and had given at least $1 million to family members. The court-appointed receiver didn't stop at Burks. He filed clawback lawsuits against thousands of so-called net winners, affiliates who had cashed out more money than they'd ever put in. Many of those affiliates believed their earnings were legitimate. The law disagreed. Money paid out from a Ponzi scheme, even to someone who thought they'd simply gotten lucky, is treated as money stolen from newer victims. Over 9,000 net winners in the US alone were sued to give the money back. Between those clawbacks and the frozen assets, the receiver recovered more than $333 million for distribution back to defrauded investors. That was just the civil case. 2 years later, in October of 2014, a federal grand jury indicted Burks criminally: wire fraud, mail fraud, tax fraud, and conspiracy. By the time prosecutors took the case to trial, they weren't calling it a $600 million scheme anymore. They called it a $900 million scheme, the full number once every dollar of fraudulent liability was accounted for. Burks' own former chief operating officer, Dawn Olivares, and her stepson both struck plea deals and testified against him. In February of 2017, Paul Burks was sentenced to more than 14 years in federal prison for running what investigators called a $900 million internet Ponzi scheme, one of the largest in American history, built entirely on numbers one man invented by hand, every single day, for more than a year and a half. On top of the 176-month prison term, 14 years and 8 months, the judge ordered Burks to pay $244 million in restitution. His victim's attorney said at the time that it would likely never be paid. The damage didn't stop at lost savings, either. For the 2011 tax year, Zeek issued IRS Forms 1099 telling the government its members had received more than $96 million in taxable payouts. In reality, Zeek had paid out less than $13 million that year. The rest was phantom income, numbers that existed only on paper, and the victims who received those forms were left to file tax returns, and in many cases pay real taxes, on money they never actually got. What makes Zeek different from a lot of Ponzi schemes is who it actually reached. This wasn't a scheme sold to wealthy investors in private meetings. It was marketed directly to ordinary people online, over 1 million of them, through the same channels used to sell anything else on the internet. Websites, emails, social sharing, conference calls anyone could dial into. The technology that makes it easy to reach a few friends with an ad made it just as easy to reach 1 million strangers with a lie.